Okay. Yes, we're getting a few yeses coming through. So they can hear me okay. Is that better now, Jack?
Might just you just sound like a robot to me. I don't know if it's my headset or not. Not a
Okay.
big deal. If no one else can hear it, that's fine.
All right. Fantastic. Well, we'll get stuck into it. Can everyone see the screen that I'm sharing? Yep. Fantastic. Okay. So again, thank you for all your time and joining our presentation this morning. We're going to go through, it's probably going to be about half an hour to go through the property and mortgage update. And then, as I said, Q&A session at the end. So please don't be scared to ask those questions. So a little bit about today's session. Obviously, it's general in nature. We're just trying to give you guys some education, an update. If you need some specific professional advice, please reach out. But we just put this together as general advice to update the market. So who's Atlas Wealth Group? If you haven't heard, we are a group that's servicing expats across the globe now, looking after financial advice, tax, mortgage, and asset management services. So we've got multiple licenses across the globe, and we've got clients all across the countries, and close to a $250 million assets under management. So a little bit about the group. Myself, Jeremy Harper, I'm the Managing Director of Atlas Mortgages down the bottom left. So if you've got questions specific to mortgages, please reach out to myself. And then we've got Atlas Wealth Group over in Dubai and the Gold Coast, and Atlas Tax in Adelaide, headed up by Ben. So the lovely young man on the call today is Jack Henderson. If you haven't heard about him, he's all over social media. So no doubt if you logged on to news.com.au, you've probably seen his face, probably trying to rattle up some of the readers on news.com.au, but he runs Henderson Advocacy and Endeavour Build. So he's a property investor himself. He's got offices across the East Coast, and he's transacting over $1 billion plus in assets for his clients. So he knows what he's talking about when it comes to property. So hopefully you can walk away with some education from his side. So today's agenda, as I said, we'll be talking about, I'll give a mortgage update first, then Jack will come in talking about property, and then a Q&A session at the end, which I think's one of the more important parts of the presentation. So to start off, where are we, heading into this federal election, which will be coming up in the next couple of months? So we just had the February RBA meeting, and we had the first cut in some time, 25 points. So that offered a lot of relief to the market. The feedback I've received from clients and even new inquiries is it's made the market very sort of buoyant. And so people are quite, excited about what's going to happen into the year in terms of interest rates. So in terms of where rates are sitting, I think it's important just to kind of give you a bit of a test or checking comparatively where your mortgage is currently to where rate should be. So at the moment, we're seeing sort of after that cut was passed on, owner-occupied mortgages sitting around that 5.7 to sort of high fives on the variable, and then this is P&I, and then investment rates now should be 6 to 6.25. So if you're not close to that, definitely come have a chat, speak to your bank, see if they can sharpen up the pencil on that. What I would note is, interestingly, which I know a lot of expats, because I was playing this space a couple of years ago, Virgin Money have decided to not pass on any of that 25-point cut. So I think that's quite a deliberate strategy to try and roll off their back book. So if you are an expat and you've got a Virgin Money loan, come have a chat, because I think that is part of their overall strategy this year. So, your mortgage is going to be quite mispriced to the market. And then further to that, just to give you an idea of where fixed rates are sitting. So again, fixed rates have come off, but there's a small discount on the variable rate compared to the fixed, on that 2-year tenure, just as an example. So not a lot of clients are taking up the fixed. Most people are opting to stay onto a variable. So what are some of the changes coming into the federal election? So Treasury has put forward a proposal to open up the lending with regards to the HEX debt. And so I ran some numbers. I don't think this is really going to move the needle a lot. There's two things to look at when you're a young borrower trying to maybe get your first mortgage. One is the net monthly surplus, and the second is the DTI. So this proposal is to exclude HEX debt from your DTI calculation. It's just not material, just doesn't really do anything, doesn't move the needle. The only thing that could be of interest is it's now allowing banks to make that assessment around what is their definition of a short-term debt. And so that is if you've got a HEX debt and let's say it could be repaid in the next 12 months, that bank can now deem that as a short-term commitment and ignore that from the loan serviceability or the loan application. Again, it's not going to make a big difference. I mean, you'd be looking at sort of a percent of the market that this could benefit. So it's one of those, policy sounds great, but when you look at the detail, it's not going to make a big difference. What our industry is advocating for is now that the rates are cut, is to ease up on that assessment rate, which is going to make a material difference. So currently, APRA still put that down as a 3% buffer on top of the actual rate that you're going for. So that's having a big impact on people's borrowing capacity. And if they do move on that, that will see a greater difference in terms of first-home buyers and accessing their borrowing capacity. And so I made some examples here around, every time the RBA does cut a rate, say 25 points, it increases the individual's borrowing capacity, depending on their balance sheet, by about 2.5% up to 5-6%. So it's not insignificant, but it makes little differences around your borrowing capacity. So I think what you need to think about there is if that improvement in borrowing capacity is happening to yourself as an expat or someone back home, and if you stack a few of those cuts up or changes to the rates, that means that people's borrowing capacities overall do increase. And so what you do see is that will come into property prices in some markets. And so if you talk about that assessment rate that I was talking about before with that 3% buffer, there's an example. So if the rate's 5.8% for a home loan, add on 3%, you're still having to qualify for that mortgage at 8.8%. And so that's why a lot of people have been working with non-ADI lenders, so your second tier lenders, because some have a 2% buffer and a bit more flexibility, so you get that higher borrowing capacity. And so moving on to another bit of update, which I know has caused a lot of confusion in the expat community. So again, the government's come out and said, we're going to ban for the next couple of years, non-residents purchasing property. And so some people assume that was expats. This is a ban on purchasing established properties as a foreign investor. So these are people who have no ties to Australia, not necessarily from a non-tax resident, but people who are not Australian citizens or permanent residents of Australia. So that does not apply to a typical expat that's living overseas. This is something that if you look at the number of transactions of foreigners buying each year, it's very minimal. And if you actually if you dig a little bit deeper, a lot of those transactions are actually still purchased by someone in Australia who has, Australian citizenship or a PR status, and they're funneling money from other family members and they're buying under that person's name. That happens a lot. It just won't get caught up in some of those foreign purchaser stats. So again, this is something that they've announced for the next couple of years coming to election. And then finally, some other changes that we have seen proposed or may come into place with the federal election around the corner. So we have seen on a state base, some tax changes have come through. We know Victoria has lowered their land tax threshold. That's had a big impact on our investors in Victoria. New South Wales made a small change, freezing the land tax threshold, which was typically or historically indexed. So it sort of rise with inflation, but that's now frozen for the short term. It's a higher land tax threshold that we have in New South Wales. So that means that a lot of people aren't being caught out with that, but just something to be mindful of if that's frozen for the next 5-10 years, similar to the bracket creep that we've all experienced or Australian taxpayers have experienced when they're with their PLYG or with their marginal tax rates, that hasn't kept in line with inflation. So we're all paying more tax because that hasn't been indexed accordingly. So heading into the election, one of the policies that the Liberal government is proposing is allowing first-home buyers access up to $50,000 from their superannuation or up to 40% of their balance for a deposit towards their first purchase. So that is quite a unique policy that the other parties haven't supported. Rental changes, there's been, again, some changes coming through Victoria just around the rights of the tenants and the landlords. So that you could probably look into a bit more, and also around sort of energy standards, which again is putting on additional cost to some of those landlords in Victoria. And then the two big ones, so there's not a lot of exact policy just yet that I could find, but negative gearing. So Labor has requested that Treasury look into what are their options around looking at negative gearing. There's no official message, but potentially they may look to modify that. The Liberal Party has opposed any changes, so that's party official. And then the Greens, well, they wish to remove that on all existing property. And then capital gains discount, again, not official, but the Labor Party is considering reducing that CGT discount, which is currently 50%, to 25%. The Liberals, again, have opposed any change. I think that's party official. And the Greens wish to remove the capital gains discount in full. So there seems to be some, differentiation in policy there between the parties. And then just finally on my end, what are some of the trends we're seeing? So obviously as rates are coming down, we're seeing, refinancing, expats looking to access equity. I'm seeing a lot more variety in the reasons why. So it could be looking to purchase something overseas because they need some deposit. They've got equity in Australia. They want to invest in another Australian property. They want to do improvements on the property. They want to consolidate some debt. They may want to invest in shares or other assets. So seeing a lot of that. As I was saying before, as rates come down, borrowing capacity will improve. So maybe if that's something you've looked at a little bit, historically when it was a bit harder from an assessment point of view, that may open up slightly for you. Construction lending, that's still huge demand I'm seeing. So, looking at engaging builders, putting together, a duplex or a full rebuild. Despite the construction costs, I don't see a huge slowdown in the demand for this because there's still a property shortage and there's still a lack of good dwellings in Australia that's available. So there's still that demand there. And then finally, for our clients that have existing land, a lot of people are starting to look at adding value via a duplex or a granny flat, which I'm sure Jack can talk on later, but they're seeing a lot of value there with that second dwelling. The market has completely changed around looking at a granny flat as a tenant. I think 5-10 years ago, it was definitely something that people would turn their nose up at. But it is a really good option as opposed to renting out a full house. It's a lot more affordable. So a lot of people do have these sort of granny flat, these dual income arrangements. So that's still a huge demand that I'm seeing. And on that, I'm going to hand it over to Jack. Thank you.
No, you're a good man. Now, I don't know how to turn my video on here, so it's not working.
That's okay.
Can you
The
solve that
screen's
issue
coming
for me,
through.
Jez?
Yeah, I'll
Cool.
go forward.
So you're going to change my slides. Thank you, Jeremy. So quickly, what I wanted to run through before I go through some of the market trends and stuff that we're seeing on the ground across the east coast of Australia is just how we think about our overarching investment strategy when it comes to building, creating a lot of wealth through property. And we work with a lot of expats and we work with a lot of people who are on Australian shores, and the strategy doesn't change regardless if you live overseas or regardless if you live in Australia. So I think what a lot of people try and do when they're building their investment portfolio is they try and do everything at the same time. So they want to get a property that's got really strong capital growth. The next thing they have is an idea of, oh, let's get some cash flow, so we'll potentially go and invest in some commercial property. Then they have this wonderful idea that, oh, we're returning home from overseas, buy a home, and everything is very muddled, and they never actually get a streamlined strategy, I suppose, to whatever it is that their goal is. So when we build out a portfolio, we firstly focus on accumulating assets and building our overall capital base. And you can see on the screen there, that is accumulation. That is Henderingo, our property flamingo. He's the Henderson mascot. And essentially at that stage of the journey, you have any investments, or you might have maybe 1 or 2 investments before you can go and generate cash flow and get freedom, which is what most people want when they go and start investing in property. You need to have the capital to be able to do that. So that's when you go and acquire your properties and you continue to use the equity that comes out of one property to accumulate more properties until you'll eventually hit your serviceability limit, depending on your personal circumstance and what your income is. And then once we've accumulated a solid asset base and we're essentially at that serviceability, we go back to those existing assets and add value to those properties, which we call the acceleration part of our strategy. And Jeremy mentioned before things like construction loans and adding value to properties through renovations or potentially even building dual occupancies and granny flats. At this phase of our investment journey, that is what we do. So we go back to the existing properties and go, is there something we can do to this property to be able to add value from a capital appreciation point of view, or increase the rental yield, potentially dwelling to the property. And essentially what that does is it makes it easier to hold the property longer term, because it requires less maintenance and you should have a higher rental yield, which means it requires less money out of your pocket to hold the property. And once you've then accelerated the existing properties that are sitting in your portfolio, we roll into what we call the incubation phase, which is essentially where we're sitting and waiting for our portfolio to grow and essentially let the marketplace do the heavy lifting. And this is real estate. Everyone's heard of the stories of nan and pop or auntie and uncle or mum and dad who have owned their property for 15 years. They bought it for $120,000 and they sold it for $3 million 30 years later. The majority of that gain happens in the last 5 to 10 years as opposed to the first 15 or 20. And this is what we focus on in the incubation period, which is having a really solid asset base, probably carrying a relatively high loan to value ratio as we move into this phase. But during this period, we go through debt reduction with just paying down our mortgages, and the property's appreciating in value, which then means our loan to value ratio becomes lower and we have more equity or more capital then to be able to use when we roll into that fourth stage, which is consolidation. And I'm going to talk a little bit more about this on following slides, but consolidation is where we then go through and sell down our residential assets, generally speaking, because residential assets are really, really good for capital growth, but not really good for net cash flow. Enjoy your life a little bit more, because even when residential real estate has no debt attached to it, it is still an expensive asset to hold by the time you factor in things like land tax and things like property maintenance and council fees and all that jazz. You've probably still got 1.5% to 2.5% of a property's value every year in expenses, excluding your cost of debt or your interest payments. So that's why we usually sell down and consolidate our residential assets. We clear out our debt. We unfortunately have to pay a little bit of capital gains tax, keeps it at a 50% discount. And then we roll into the evolution phase of our investment journey, which is then when we start investing purely for a cash flow yield and we focus less on capital growth. So that's where we usually start to focus on things like commercial assets, where we're getting much higher net rental yields that have much lower costs because our tenant pays all of the outgoings, as opposed to us being the landlord. And that's when we start to get really, really strong passive income and can enjoy our structure. Every single client's portfolio exactly the same. The variance between different portfolios is just the time frame people have, the incomes they have, and obviously the capital they have to be able to make all these things happen. But I can assure you, very few people structure portfolios like this. They start with buying an asset, and like I said, they then buy an owner-occupier, they then sell the investment, and then try and buy a commercial, and it's very muddled, and they often get an inferior outcome to what they were hoping for in the start. Jez, if you can slide to the next slide, please, mate. Cool. So essentially, what I wanted to run through here was a few trends that we're seeing and some data that we've got from, I guess, the overall marketplace. So what we are seeing a lot of is expats who are living overseas, planning to return home in 5 or 10 or 15 years. Everyone's got a slightly different time frame they're working with, but they're preparing for that now as a return date to get into the marketplace, because they want to, capture a foot in the marketplace right now, be able to keep up with the growth on the overall marketplace and allow their capital to grow with the market. And then when they end up returning home, they have the ability either to leverage off those properties or sell those properties down and roll that into their owner-occupier property. And the reason we are telling most expat clients to focus on investing as opposed to buying the owner-occupier home that they'll one day move in. Generally speaking, people's owner-occupier homes are for personal reasons. They obviously usually they spend more money on their owner-occupier than they do on investments. And the rental yields, when you're looking at higher priced property, is generally much lower. So they cost you a lot more to own. And obviously usually being a non-tax resident, you don't get those beautiful tax benefits that an Australian resident gets. So we generally are telling our expat clients to go down the investment purely on numbers and make sure that you're getting the strongest return on your investment. And then when you end up returning home, you can use all of those gains to buy your home, and hopefully buy it with minimal to no debt. That's what we generally say. And actually, we had a client recently, Jeremy, where did the guys return home from? It's the UAE, I believe. You're in mute.
Yeah, it was from the US.
Yeah, US, sorry. They bought an investment 5 years prior, I believe it was, doubled in value, and they were able to then use that to be able to get into their owner-occupier home in New South Wales. Median data is give or take $900,000 now for a home in Australia. I think that was meant to say up from 798 in July of 2024, because I don't think July in 2025 has happened yet. But essentially, the marketplace in Australia is still very stable. We haven't seen a huge kick in buyer activity. Interest rate drop, which just come into effect, I believe, this week or last week. But it actually has been very consistent over the last 12 to 18 months in most of the capital cities outside of Victoria. Victoria has really struggled over the last couple of years with those land tax changes and the other changes that they've made to vacant land holdings. That's really pulled the investor demand out of the marketplace. But we are now starting to see it trickle in because Melbourne as a city state is becoming cheaper and cheaper, and now places like Adelaide and Perth are actually more expensive, which is very, very unusual. So now I think people are seeing the opportunity in Melbourne because it is much more affordable than it potentially once was, and people think that it's obviously not going to be there for a very long time. So we are starting to see investor demand move back into that marketplace. And generally speaking, what we see and have seen in the past is as interest rates start to creep down, like Jeremy said, your borrowing capacity increases, which gives you the ability. And when people can spend more money on property, they absolutely will, which obviously then drives long-term price growth, which as an investor or a homeowner, that's why we all do it for, right? It's not just a roof over our head. We generally want to make sure our money's working hard for us. So interest rate drops are generally good things when you own real estate. And we should start to see that trickle through, I think, over the next sort of 12 to 18 months if we get all these rate cuts like have been predicted. Jezza, roll on to the next slide, please, mate. Opportunities we're seeing, again, I'm going to focus more on investors because, if you're an owner-occupier, it's just about buying your home. So essentially, what we're really focusing on a lot and have been over the last 3 or 4 years is opportunities where we can add value to properties. And we initially saw the opportunity to buy properties and add value to them during that COVID time where if you had kept up with Australian news, you would have seen that construction costs had gone through broke. A lot of people thought renovating was stupid and too high a risk, and they threw it out the window, which meant unrenovated properties and properties that needed work done to them become less appealing to a lot of buyers, which we saw as an opportunity. That's a photo there of myself and a couple of the guys standing out the front of a property that we were renovating or about to start renovating. And we would now renovate probably 100 to 150 properties every single year at different levels because there's such an opportunity to spend money on it, get an increase in the capital value of that property, and then also get an increase in the rental yield, as opposed to just going out there and buying something which is already finished and you're paying an increased price for someone else's work. That's not a new trend, but it's a continuing trend that we're seeing. And being able to buy properties where you can add that second dwelling to them, we're really bullish on and granny flats and second dwellings, because people call it in Australia. There's a huge lack of rental supply. And if you buy the right property that you can put a second dwelling on, you can drive a rental yield, to nearly 7% we've seen in some of our recent second dwellings, which is just crazy. And this is not in regional areas where, you're getting really high rental yields and low capital growth. This is in, capital cities where you buy the right properties that you're usually getting a 3 to 3.5% rental yield on. And you manufacture that yield to be 7%, which is crazy. And it also makes it much easier to hold the property long term, because it brings that property's cash flow up to, near net neutral if you're carrying an 80% loan to value ratio on that property. We are also seeing a positive thing with rates obviously cycling downwards. It essentially gives us a bit of a cash flow ease as an investor, because our mortgage repayments are lower, and hopefully our rents continue to property should start to cover some more of the negative cash flow that I'm assuming lots of people have gotten used to over the last 3, 4, 5 years with rates going up. When rates were at 2%, you could have purchased a property at 3.5% as a rental yield, and it would have been cash flowing itself. If that same property is still achieving that yield, you'd be negative by a pretty severe amount. So by rates going down, that's giving us the opportunity to be able to have more cash in our pocket to pay our bills, which is great. Another thing which a trend we're starting to see is, because a lot of the affordable areas, or what were affordable areas, got absolutely hammered during COVID and during that COVID time up until only recently with investors. So we saw huge price gains in places like Perth and places like regional Queensland and places like Darwin, for example. Like, a lot of investors were jumping into these marketplaces, and some of the prices in these markets have doubled in a few. All of a sudden, the disparity between these more regional or affordable marketplaces and more premium markets is much lower now. So we're starting to see more and more buyers looking at more premium markets, because the disparity between what was once an affordable market and a more premium market is not that high now. Which we've always focused on premium markets, and we will continue to focus on premium markets because they give us the historical track record of growth that we track. But it's good to start now. We're not trying to chase the quick dollar. They're looking so the gap isn't that big. So they are investing in better marketplaces, which is good. I guess the last thing I want to cover off on this slide is commercial property. More and more everyday investors are starting to move into the commercial sector. I reckon up until only 5, 6, 7 years ago, commercial property was really only for more sophisticated investors. A lot of people didn't understand it. A lot of people didn't understand how it works. I think there's a lot more education and information around it. People are becoming more familiar with it. So we are seeing the commercial property market become a lot more in demand, I would say. A lot more clients are curious around it, and they are seeing it as a solution to, a cash flow constraint, because obviously in commercial property, you generally get much higher rental yields. Those rental yields are usually much higher from a net point of view as well, not just a gross rental yield, because your tenant pays the majority. And you don't necessarily need to have millions of dollars to get into a good commercial asset. So we are starting to see a lot of investors, and have done over the last 3, 4, 5 years, push into the commercial space, because it's a really solid asset. Industrial is probably the market leader there. Jez, next. I think I've already covered off, the RBA rate cut hasn't really done anything to the marketplace as of was cut a few short weeks ago. But I think if we start to see another rate cut, generally that'll give buyers more confidence, and when buyers have more confidence, they spend more money, like I said. Also, traditionally, as we move into an election year, lots of people have the let's just see or wait and see what happens with the election. We used to hear that stuff all the time. we haven't really heard it all that much this year. I don't think there's anything overly impactful in either of the parties' party policies. It's going to have a huge impact on the property market. Like Jeremy said, there's a few things that have been mentioned, but it's not I think Labor maybe 2 years ago, they were really driving the negative gearing and scrapping that. So that was a really big piece of property, and a lot of people were nervous about what would happen. There isn't really any policies this year that they're pushing real hard. It's going to have a negative impact on the marketplace. So we're not really seeing the whole let's wait and see. Lessons learned from years where people did say let's wait and see. Generally, everyone tries to get back into the marketplace at the same time, and because of that, things get more expensive really quickly. And like I said, there isn't a huge push this year on pulling back the marketplace. There is a big push for first home buyers. Liberal has a really cool first home buyer incentive around being able to access your superannuation, and not just in the past with, if you make extra contributions, you can pull those contributions back out to use as a deposit. From what I understand, Liberal are saying that if you have money in your super, we will allow you, to access up to $50,000 of that to help you get into the marketplace. So you could essentially have no money in your own account, but have 50 or 100 grand in your super account, and you can access up to 50 grand of that. And then if you look at the first home buyer incentives in a lot of the states in Australia, 5% deposit, no lender's mortgage insurance, no stamp duty, 40 grand to be able to get into a $600,000 to $800,000 asset. So I think that's really cool, and I think it'll help a lot of people get in the marketplace who maybe don't have the capacity to save, but their superannuation has been building for 5 or 10 years in the background. And
Fantastic.
there you have it, folks.
Thank you, Jack. So we're just going to put together some screens on some to-do items. Again, if you've got questions, put them into the Q&A box, and we'll get to our Q&A section shortly. Just a little bit of a shout out. We've got the Expat Mortgages podcast with some episodes I host with James Ridley, another director at Atlas Wealth. So please subscribe to that if you want to listen to that. We talk about all things property and finance. You can find us on Spotify and Apple Podcasts and SoundCloud. Another thing to do is there's quite a big group on Facebook, the Australian Expat Financial Forum, which I know Brett and the team manage that. So that's a lot of questions in there. So if you've got questions, jump in there. Someone will help you out. And that's just a good space for expats to bounce ideas off each other regarding all things finance. So finally, we will throw it over to the floor. So Q&A section. So I've got a couple of questions here about, so first one, I've got a question here. This is for you, Jack, from Cheryl. So you mentioned earlier about the build costs. In terms of the build costs, what do you see around, I guess, labour costs and material costs in the future? Is that going to be pretty consistent, or do you see some challenges there?
No, I mean, yeah, we run a building operation, and I think it's going to get much better in the next few years, because essentially what happened over the last 5 years, say, is property prices increased, but the building sector, I should say, because it was everything in the building sector, increased faster. The gap between an unrenovated product and a renovated product got smaller and smaller because it cost more money to be able to do it. And what we saw in residential building is a lot of builders went broke. A lot of development sites that maybe were feasible when they were purchased become unfeasible when they got into the builds. And a lot of developments right now, like I would say and confidently say that 80 to 90% of property developments right now that are coming out of the ground, and a lot of them are just not coming out of the ground. And that's because what it costs to do and what they sell for are two different things. But what we'll start to see as the marketplace starts to move is property prices will increase, the building supplies and labor will likely stay the same, and they'll potentially subside, which means the gap between what it costs to buy and what it will sell for at the end will get bigger. And all of a sudden, I think you'll start to see a lot more development happen, and a lot more people doing works two properties. But I think we've seen the big increase from.
Yep. Okay, fantastic. I've got a question here from Tom. This is probably for myself. So, Tom and his partner is a non-citizen, a French national. So, can she also access a home loan? So there's two things to think about. There's the ownership, which is, who's on the title of the property that we're trying to buy. Is it a citizen or permanent resident or a non-res? And then from a lending point of view. So on the ownership, you would just need to make sure that there's some exemptions that apply around a non-national purchasing, and there can be regarding being a spousal relationship. So you just need a bit of advice around that. From a lending point of view, it can get tricky. A lot of the mainstream banks won't accept that non-national or that non-residence income. So from a simplicity, from a lending option, it's always I'd always look at trying to get the deal done just in the Australian citizen's name. It means that the cost of funding is going to be much lower because we can go to a mainstream bank, and we're not going to be paying any premium on interest rates or risk fees. So that would be sort of my advice. Of course, that comes down to serviceability and who's earning the income in that relationship. But if we can do that, that would be my recommendation. I've got another question here from Frank. So he's got an investment property in Queensland. Can he use the equity to purchase another property? Yes, he can. So again, we'd get a valuation done at market. If it's, like a lot of Queensland's done quite well in the last couple of years. So depending on how long you've had the property, there may be some substantial growth, and whatever the valuation is, pair that back depending on the lenders, let's say 80% or even 70% of that value. That's the equity that we can work with, less if you've got an outstanding loan on that property, take that away, and that's the equity we could use for the second property. So definitely. So if you're overseas and you've got good income and you've got the equity sitting in a Queensland property, let's go. Let's get that next property. Okay, I've got a question from Ray. We could probably both answer it, Jack. So he's it's going to be an expat for the next 5 years. He's got a inner city investment property. So it's got river and city views. That sounds quite nice. He's had it for 16 years, all paid off, but because of expenses, body corp rates, things like that, and he's being taxed as a non-resident, it's obviously yielding quite poorly because he's obviously paying that net income back to the ATO. So his question is, what should he do with the property? Sell it with 3 years as a non-tax resident and then cop that tax, invest it in the US, or look for other investment properties. I mean, what I would say from my point of view is, like I was just answering to Frank, it sounds like one of the issues is you've got no lending against this property. So yes, you're paying a lot of outgoings and then you're paying tax on top of that. So one way you could look at that is leveraging the equity, maybe 30% down payment using the equity on the current property, take out a loan on property 2. So the property 2 is effectively geared up at 100%. So you can claim 100% interest on property 2, which when you do your Australian taxes as a non-res, you have to put the two together. Property 1's obviously making some taxable income at the end, offset that if you're running a loss on property 2, and that might be something to think about, as opposed to having to pay, non-tax rates to the ATO every year. You're now instead using that difference to leverage up for that second property, and particularly if it's one that maybe in a good growth area that could get you where you need to be over the next 5 years whilst you're an expat. So that would be something I'd be thinking about in terms of investing in the US. Yeah, that's not my wheelhouse. I don't know too much about that. What about you, Jack?
Yeah, so I'm only a big believer in property when you are using leverage. As personally, from my point of view, much better investments out there in the world that'll give you a much stronger return from a net point of view outside of property when you compare them side by side with no leverage. So if you've got a property, I'm assuming if it's got river and city views, it's probably in Brisbane. The net income on that would be 1.5%, 2%, maybe 3% total, which is terrible. So yeah, you could either gear up against it and go buy more property and obviously get the growth off the back of that. Yeah, or liquidate it down. You'd have to work out what your tax position is on that and then invest that money into something else. But yeah, property really only excels, I believe, when you're carrying debt.
Yep. Okay. that looks like we've got all the questions. If you've got any further questions, feel free to pop them in now. Otherwise, we might close out the Q&A session. So I'll let any questions filter through. And just as a little final slide for those that want to keep up to date on the socials, please make a note. If you are, frequent any of these platforms, feel free to give us a like or a thumbs up, join the groups and join the conversation. And after this, we'll also send through the slide notes, the recording of this session, and we'll also get a link to Jack's website. I don't think he mentioned it, but he's put together a pretty cool course on how to actually build out your portfolio. So we'll put a link into the notes of the email. So feel free to interact with that for your knowledge and reach out to Jack directly if you've got any questions around that. But some pretty cool education there that he's been working on. But if that is all, I will close it off. Thank you everyone for your time. Thank you, Jack, for your time. And if you've got any questions, please reach out to us. Great. All right. Thanks, guys. Have a good day.